Hello everyone, welcome back to Financial News in Palos Heights. Today being September 4th, 2019. The summer is going by very, very quickly, Paul. It just seems like we just started summer and here we are talking September.
It went by fast.
Yeah, I'm a little disappointed in how quick that goes. Really does. Paul, I'm going to let you take it from there.
Yes, I'm going to start bringing the latest news to the viewers at home that's affecting the markets. And again, it's everything to do with trade tariffs and negotiations between China and the U.S. So I've got some notes, some updates on that to bring you. As a fact, in 2017, U.S. companies generated sales of approximately $376 billion in China. So there's more to the trade war than just the tariffs. When evaluating the economic risks to each combatant, there are several avenues to consider, which could be reduced exports, the inflationary influence on tariffs, currency implications, and hits to consumers and or businesses and their confidence and their spending are usually key factors that are all studied in this. Today, however, we're going to highlight a factor not often discussed in detail, and that being the sales generated by affiliates of U.S. multinational corporations operating directly in China's domestic market. Not to be confused with exports to China. These are companies operating directly in China. Now, the availability of this data is difficult to accumulate, and what becomes quite dated as we get it. But to the best we can figure out, the U.S. Bureau of Economic Analysts, the BEA, just released its data now for 2017. That's how long it takes this stuff to compile sometimes.
Unbelievable.
And we do get a report only annually. So, interesting note, according to the Foreign Affiliates Report, U.S. multinationals generated sales of $375.6 billion in China during 2017, or about 6% of the total sales generated by U.S. foreign affiliates in the year. Manufactured good represents the bulk of business operations at 64%, that according to the BEA. Computers and electronic products accounted for 23% of the total, followed by chemicals at around 11%, transportation equipment at 8%, machinery at 7%. Over the preceding last 5 years, so going back to 2012, sales in China grew at an annual rate of approximately 10% per year, while total foreign sales grew at just 1%. So big difference there. So given this data's delayed availability, it's impossible to accurately gauge the impact that the trade dispute on U.S. affiliate sales in China are taking right now. However, the data could become more important should Chinese leaders choose targeting actions against U.S. brands operating in the country as a means of further attacking the U.S. during this trade war. Again, we're talking a lot about trade wars here. We know there's other things that influence the markets, the Fed, company earnings, of course, but the trade war seems to be what everyone's talking about. So I'm trying to bring people some of the latest developments.
Yeah, you talk about the Fed. We're talking about possibly a rate change.
Yep.
Even this month in September. So lots of things are going in. I want to apologize for not introducing Paul Munichol, who is with Ameriprise, giving you all this data, and myself, Ron Jankowski, with Channel 4 in Palos Heights. And I'm also going to give you the Ameriprise financial notes as of this morning, things that are interesting for those that are investors, small-time investors. S&P 500 futures are higher on positive developments in Asia, and Fed rhetoric for a possible rate cut in September, what we were just talking about.
There we go. I mean, the debate is how much the Fed may cut. I mean, a lot of people are expecting a rate cut, if not this month, potentially more this year. And will it be 25 basis points? Could it be 50 basis points? The market's waiting and wondering.
Yeah. And 10-2 Treasuries moved out of the inversion territory with a general steepening of the yield curve.
Yeah, that's one that people have been watching. That's something that's driven the market down in the past.
I'm just going to say that, right.
That inverted yield curve, but the the rate on these bonds are so close that it doesn't take much to invert the yield curve, but I'm glad that we're back to a normal curve.
And Asian markets are strong, led by Hong Kong, up 4% on CEO Lam's formal withdrawal of the controversial extradition bill.
That was a bill that was highly debated for about 3 months. I mean, it caused a lot of violent protests over there, and it was 3 months of controversy in Asia's largest financial hub. So it's good to see that that's been resolved, and that's one reason why the markets are higher.
Yeah. And WTI crude oil is trading 1% higher, and gold is down 1%. Microchip is higher pre-market after reiterating guidance, while Tyson lowered guidance on multiple headwinds. Now, that's hard for anyone to understand, all those words, and maybe you could kind of explain that a little bit, Paul?
Guidance on earnings and projections for sales.
Yeah.
So obviously, as you reported, Microchip, I think, had positive earnings.
Higher pre-market, yeah.
And Tyson is forecasting
lowered guidance.
That's going to affect stocks, and those two in particular.
That's what I wanted you to mention, because those that are investing might want to take a second look at both of them.
Exactly. So trade tariffs, Fed decisions, things that happen in Asia all affect the market in general, but company specifics, like you mentioned on those two examples, are going to affect those companies.
And where the indexes are, S&P 500 is a plus 18% year to date. The Dow is a plus 15% year to date, and the Nasdaq is a plus 20% year to date. Paul, is there anything else that you want to add to this before we leave this show?
Just despite all the recent volatility we've had in the market, I mean, we're still posting some pretty strong results in the market this year. So it's been a good year for those that have been invested.
And most of it is overreaction in the marketplace.
Yep.
Have you noticed that within 2-3 days we recovered?
And our analysts at Ameriprise have said that potentially we may not be in a recession or becoming into one, but the market may act as if there is one. As you mentioned, overreaction to news, inverted yield curves that don't even close that way. The market can overreact, and it's just something worth noting. So we may not even be in a recession, but the market could still act like it.
Exactly. Well, okay, Paul, for Paul Munichel and myself, Ron Jankowski, we're going to ask you to stay with us. We are going to turn the show over to Your Money. Paul usually has a topic that might be of interest for you in your profile. Stay with us. We'll be right back. Thanks for staying with us. We're back with a show called Your Money, and we're going to be talking about the expansion of the economic situation, and I'm going to read some notes here, and Paul's going to kind of respond to me. The current economic expansion is now the longest in U.S. history. What does this mean for your finances, Paul?
Good question, and this is going to kind of go along with what we talked about in the first half of the show today a little bit. I mean, just recently, the market reached its 10-year anniversary for this U.S. economic expansion. So because of that duration in time, people, and because of the returns that you mentioned in the first half of the show, year to date for the market, people are just expecting this recession to come. And what I want to point out to the viewers at home is, this is key, recessions do not come and market expansions do not die because of old age. So just because we've recently hit our 10-year anniversary of this expansion does not mean that because it's been so long, it must end. Yes, the recession will come at some point and the expansion will stop, but just because we've expanded for a long period of time, do not plan that it just needs to end.
And also, the Fed's playing a game with the interest rates sharply higher or maybe lower. Huge impact.
Yeah, I mean, the interest rates, the Fed, as we talked about in the first half of the show, are looking to potentially cut interest rates again in a way to maybe manipulate our currency. It might have something to do with the trade war with China, like we talked about again, because they're definitely manipulating their currency, and our president, love him or hate him, is doing what he thinks must be done to get us on the same plane field.
Paul, in your words, what would create a setback today?
So there's multiple things that can create a setback. We got to remember that the market should be driven by company earnings. So you mentioned Tyson Foods in the first half of the show. The stock market should be moving by what corporations are doing. Are they making money? Are they losing money? So we cannot lose sight of earnings. Recession does not necessarily mean a stock market drop. They usually do come hand in hand. But when people look for the market dropping, saying that's a recession, it doesn't necessarily have to be that way. A recession could be a lack of employment. It's definitely going to be the economy slowing, and that will bring the market down. So we want to look for developments, the things we've been talking about regularly on the show to our normal viewers. That's why we talk about the same things over and over again, because that's the driving news that could derail this market cycle. That being high interest rates, that being developments in the trade war, and that could also be falling earnings with corporations.
Okay, and then really, how do you prepare for future uncertainty then?
Well, I mean, that's a trick question, right? How do you
Right.
prepare for what you don't know is coming?
Right, $64,000 question, right?
You've got to have your investments appropriate for you. So we always preach asset allocation and diversification. But what we don't talk about enough is investment timeframes. So how to best prepare for what may be coming. Examples: if you plan to buy a new house or a new car in the next 6 months, you might not want to be invested in the market anymore. The time frame is too close to risk losing that money. But let's say you're not planning retirement for 10 years. Whether the market goes into recession tomorrow or a week from now or a year from now, you've got a long-term perspective, and stocks will give you growth over the long term in that time frame.
So there's recovery.
There's recovery time. So it's very critical. Of course, diversification, which I think everyone at home knows about, but time frames is something that we look at Ameriprise. It's one of the first things we look at before we make any investment recommendations to people.
Okay, well, I think we're pretty much at the tail end, unless there's anything else you want to add to this. I mean, you really covered it in a nutshell for what you've just said.
Yeah, the only thing I'd like to add is, if you've got questions at home on your time frame, about your diversification, about your asset allocation, I'm here to help. More ways than just being on the air. Feel free. You can always reach out to me directly at Ameriprise, and I'll do my best to answer your questions. I can always be reached at 708-226-3412.
All right, thank you, Paul, for coming out with this guidance, more than anything, for those that are viewing the show. For Paul Munichel with Ameriprise Financial, myself, Ron Jankowski with Channel 4 and Palos Heights, we wish you a good investment day.